Jeff Gundlach just came out and predicted the demise of the dollar.
You're going to see the dollar really perform badly.
I'm going to tell you why he thinks it will crash and whether or not I agree with him in 3 simple, fast steps. Step number 1, let's go over the main reasons why Jeff Gundlach thinks the United States dollar is doomed. Let's start by looking at a chart going all the way back to 1930 to today's date. On the left, we go from 30%. Now, you're going to have to follow this one. A little bit weird. It goes from 30% up to 0 and then 5%. So, actually, if I was thinking this through, these should be negative numbers. I forgot to do that. So, editor, help me out, or viewer, use your imagination and pretend that these numbers are negative. I just noticed that mistake. Okay, getting back to the chart here. This is a representation of the U.S. deficit relative to GDP. So going back to the 1930s, it was about flat. And then as you would imagine in World War II, it goes way down. So the deficit as a percentage of GDP, went way up, I guess, to 25%. And then it goes down, 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 down. So actually what I should state before I go any further is that anything above this 0% would be a surplus, a budget surplus, meaning they're bringing in more revenue than they're actually spending. Anything below this line would be a budget deficit. So they're spending more money than they're bringing in. Throughout the 1950s, 60s, 70s, it goes down. It really starts to go down quite dramatically in the 1980s. And then in the 1990s, it actually goes up to a point just before the dot-com bust, where once again, we had a budget surplus. Amazing. But then you guys know the story from there. It gets worse and worse and worse. We get down to the cerveza sickness, and it was about 15%, the U.S. deficit as a percentage of GDP. This is why you've been hearing lately that the United States is running wartime deficits. This is exactly what they're referring to. And the cerveza sickness, no longer a big deal, at least for most sane people. But the amount of money your drunk, insolvent Uncle Sam is spending has not gone back to its normal levels. Jeff Gundlach would argue that the government is going to have no choice but to deficit spend more and more and more, and this is going to have a massive negative impact on the United States dollar. So, editor, do me a favor and let's cut to another clip of Jeff Gundlach actually explaining his view in more detail.
When the recession comes, you're going to see the dollar really perform badly because the budget deficit is going to go to 20% of GDP, and it's going to be really ugly. I think here's the big picture. I think the dollar weakens tremendously in the next recession. I think it's because the response to the next recession is going to be a complete disaster relative to our fiscal position. And that's going to be the wake-up call where we realize that the United States is bankrupt, that we cannot honor our liabilities. The United States has nearly $200 trillion of unfunded liabilities. That's almost 8 times GDP. For us to pay that in today's purchasing power, we would have to pay 10% of our GDP for 80 years. We have to have 4 generations of depression. We're not going to do that. What we're going to do, therefore, is go to a complete abandonment of the dollar, and we're going to see a restructuring of the U.S. financial system.
So basically what he's saying is the United States has all these unfunded liabilities, like Social Security. These liabilities are off balance sheet, and therefore the budget deficit is going to get bigger and bigger and bigger. This is going to make the debt to GDP ratio explode. Remember back in the 1940s, we were right around 120% debt to GDP, and we got close to that number during the cerveza sickness, but a lot of people would argue that that was just temporary. But what Gundlach is saying is no, that is now permanent. That is the new normal. And it's going to go from 120% to 150% to 200%. And the next thing you know, we're going to be very close to Japan, where debt to GDP is at 250%, and there's no end in sight. We are still running bigger and bigger deficits every single year, especially if we go into an economic recession where tax receipts plummet. So let's think about this for a moment. If the deficits are going to continue to explode, this means the United States Treasury, Janet Yellen, is going to have to issue more and more debt. In other words, more and more treasuries. So the next question becomes, well, who is going to be your buyer? And Jeff Gundlach would argue that inevitably it's going to be the Federal Reserve. And the process of them buying all of this additional government debt is going to lead to more currency units in the real economy chasing goods and services. And this process is going to make the dollar crash. So just to make sure we're all on the same page, let's go over a visual as to how this works. You guys will see my incredible artistic ability on display. So we've got the government right here, and obviously this guy, your drunk, insolvent Uncle Sam. So he is going to spend money like a drunken sailor. But in order for him to spend all of this money, Janet Yellen has to issue a lot of treasuries because he's going to be deficit spending. There's no way they can collect that much money in tax revenue. So Jeff Gundlach's point is you've got the investors out there. We'll call him Ian the investor. And they're going to look at all of these treasuries that are being created and all this supply that's being dumped onto the market. And they're saying, wait a minute, you're doing this now and it's going to get even worse in the future. So there's no way I want to buy one of these treasuries because the yield that I'm getting most likely won't keep up with the rate of inflation. So the purchasing power of my treasury will decrease over time. And on top of that, interest rates in the future will most likely be a lot higher because of all this deficit spending, and therefore the value of my treasury will decrease as well. So you've got investor Ian looking over at Janet Yellen, giving her the big old thumbs down. No way, I'm not interested in buying your government debt. So what this does is it makes the yield shoot higher and the price go down because there's that inverse relationship. Well, if the yield is increasing, that means the interest payments that Janet Yellen has to make on all this newly issued debt is going to explode higher. And at a certain point, your drunk, insolvent Uncle Sam isn't going to be able to afford the additional interest payments. This is Jeff Gundlach's argument. So then the Federal Reserve is going to have to step in, basically like they did in 1940. Now, there's some debate about that, but we'll just assume this is how it played out. Or they'll have to do the exact same thing that Japan did with yield curve control, where they just buy as many bonds or treasuries as necessary to peg the long end of the curve at a specific interest rate, and maybe even the front end of the curve. But then Jeff Gundlach would point out that if the Federal Reserve is buying all of these treasuries that Janet Yellen is issuing, what they're doing is creating bank reserves to do that. But if they're buying all of these treasuries from non-bank entities in the real economy, then this is going to increase M2 money supply. In other words, the amount of dollars that are circulating in the real economy chasing goods and services, and that's going to be very inflationary. So those treasuries go onto the Fed's balance sheet, but as a result, and you can follow this black line going right over here to the government, basically what you have is the money that they're spending into the economy is coming directly from the Federal Reserve. This is Jeff Gundlach's main argument, and it's why he believes that especially in the next recession, where the deficits will most likely explode once again, and this could be at the end of 2023 or maybe into 2024, that the dollar will plummet in value. Step number 2. Now let's go over some historical data to determine the probabilities of Jeff Gundlach being right or wrong about the dollar. And then remember, at the end of this video, I'm going to tell you whether or not I agree with Mr. Jeff Gundlach. But let's get right into a chart of the United States debt. The federal debt going back, what is this, about 5 years. So 2018, the overall federal debt was around 21 trillion. What is it today? A lot higher, to say the least. Right now, we stand at $32 trillion, over $32 trillion. And that was as of Q2 of 2023. So as of right now, it's obviously a lot higher. I would say probably north of 33 trillion. But what's just mind-boggling is going back to just before the cerveza sickness. So let's say Q1 of 2020, the overall debt was at 23 trillion. And then just 3 years later, as we said before, it's roughly 33 trillion. In other words, the debt has gone up by $10 trillion in just the last 3 years. Said another way, the debt has increased by about 50% in just the last 3 years. Let that sink in for a moment. Oh, but wait, there is more. Let's not forget about the Fed's balance sheet. We look at it just prior to the cerveza sickness, and we were around, call it 4 trillion. Where are we today, just 3 years later? Oh, that would be $8 trillion. And it's actually come down over the last year, but it's still double the size, approximately, than it was just prior to the cerveza sickness 3 years ago. These are absolutely staggering numbers. And to Jeff Gundlach's point, it's only going to get worse. But we're not done. Let's look at what happened to M2 money supply during this time when the Fed basically doubled their balance sheet and the amount of debt, the federal debt that we have, went up by 50%, over $10 trillion in a very short period of time. What happened to M2 money supply? Check this out. We started 2020 around $15 trillion. Where are we now? $20 trillion. So let's think about this for a moment. In just that short 3-year time frame, the amount of currency units increased by $5 trillion. That's an increase of roughly 30%. And when you sit back and think about it, these numbers are really tough to get your head around. They're Banana Republic type of numbers. They're Weimar Germany type of numbers. But now let's look at a chart of the DXY. Going back to the beginning of 2020, the dollar was about 96 on the DXY. And this is a measurement of the dollar versus other currencies. Today, you would expect that it would be way lower, dramatically lower. But you'd be wrong. The dollar is hovering right around 105. In other words, the dollar actually got stronger against other fiat currencies in this time frame when the government debt, the deficits, and the Fed's balance sheet exploded higher. But let's remember Jeff Gundlach's main point that these massive budget deficits are going to put a lot of downward pressure on the dollar, potentially creating a dollar crash. All right, well, let's go back to that chart that we had on the whiteboard. And I want to point out that just prior to the dot-com bust, as we said earlier, the United States was running a budget surplus, meaning they were bringing in more money than they spent, as hard as that is to believe. And like we went around the whiteboard, you can see how those budget deficits have just gotten worse and worse and worse to the point now where we're almost back to where we were during World War II. But let's go right back to that DXY chart. And instead of looking at the last 5 years, let's go back to, I don't know, let's say 1983 or so. And then let's zoom in on that time frame when the United States was actually running a budget surplus. So right around 1999 or 2000. And we can see right around April of 2000, the dollar was roughly 105 on the DXY. And remember, this is when we're running a trade surplus. Now, when we are running massive wartime deficits, the dollar is right around the exact same level. Step number 3. So, do I agree or disagree with Jeff Gundlach? Well, as far as the government deficits continuing to increase, and that's putting it mildly, as far as the debt going higher and higher and higher, and as far as the government being flat out broke, how could you not agree? I think that's pretty obvious based on what they've been doing over the last 2 decades. I don't see why that's going to change. I agree with Jeff. It's going to get a lot worse in the future. As far as consumer price inflation, the second point, I would agree with him there as well. Domestically in the United States, I think the 2020s will be an inflationary decade, very similar to the 1940s. But we have to remember that inflation doesn't go straight up. It peaks, it comes down, we have disinflation, sometimes we even have outright deflation, like we saw in 1949, just 2 years after the CPI was at 19% right here in the United States. Well, let's go back to the GFC, and either it was Q1 or Q2 of 2009, we had deflation then as well. So it's always a roller coaster ride. But I believe over the course of this entire decade, we're going to look back and we're going to say, yep, that was an inflationary decade, just like the 1940s and just like the 1970s. So the last question becomes, do I agree with Jeff that the dollar will crash relative to other currencies? Here's where I have a little different view. Let me show you what I'm referring to. So we've got the United States right here. Obviously, my artistic ability shining through once again on the whiteboard. Government on the left, Federal Reserve on the right, and they are going to be creating tons and tons and tons and tons of these new dollar currency units. In the last step, we saw how M2 money supply just went parabolic during the cerveza sickness, and it'll likely do the same thing in the next recession. Okay, so the average Joe going to get really pissed off because prices in the United States domestically will likely go up, like we talked about here. But how are these dollars going to get outside the United States? Well, likely through our trade deficit that will increase just like our budget deficit because we don't produce a lot of things in the United States. Although that's kind of changing now to a certain degree, I don't think that we're going to see trade surpluses anytime soon. So those dollars get out into the global economy. So the first thing I want to point out, and the first thing you really got to get your head around, is the supply-demand dynamics with the United States dollar are much, much different domestically and internationally. Why? Because at the end of the day, the dollar is the reserve currency, and it's what 70% of transactions globally are settled in, even between countries that don't include the United States. I know a lot of you are saying, well, George, that's changing right now. Just look at what the BRIC countries are doing, the BRICS, and their gold-backed currency. All right, more on that in just a moment. But we have to recognize the global economy is about 120 trillion. So let's just assume that 70% of those transactions are settled in dollars. That means we're at 70, maybe $80 trillion circulating in the global economy. So let's just say that $1 trillion comes out of the United States every single year due to our trade deficit. It's a drop in the bucket. It's basically like standing in the ocean when you're a little kid and having to go to the bathroom. And instead of going up on shore, you actually take a leak in the ocean when you're out there swimming in the waves. Are you adding water to the ocean? Yeah, you are. But it ain't going to make that much of a difference. It's not like coming home and taking a leak in a small cup. Then the impact is going to be huge. And you've got to get your head around that, as ridiculous as it may be. You got to get your head around that concept to understand the dynamics of the dollar outside of the United States relative to other currencies. But let's go back to this BRICS argument, because there what people are saying is, okay, George, I understand how 70% of these transactions are settled in dollars, but that's going to be a lot less in the future. And if a lot fewer of those transactions are settled in dollars, that's a lot less demand for dollars. With the supply increasing, that means dollar crashes against other fiat currencies. All right, well, let's think through the aggregate balance sheet of the global economy in terms of the amount of dollars that are held by governments, private entities, corporations, average Joe and Jane, all of the entities outside of the United States. So let's just assume for a moment that there's $100 trillion on the asset side of the balance sheet. Well, how were those dollars created? outside of the United States. As most of you know, they're created in the Eurodollar system. In other words, they're created by banks lending them into existence. So if there's $100 trillion on the asset side, well, there's also $100 trillion on the liability side of the balance sheet. And again, all created by banks. In this example, we've got Bank A and Bank B. So let's say we've got the average Joe's Saudi Arabian cousin. We'll call him the average Muhammad. He's got his slick sunglasses on there and that the white robe and whatnot. And he looks at the United States and says, no, I do not want these dollars anymore. I'm done with these dollars. I'm sick and tired of them. The United States has taken advantage of the dollar for all of these decades, and now we're forming a new BRICS currency. It's going to be gold-backed, and we're just going to transact with one another using this new currency. We'll call it the digital yuan or the digital ruble, something like that. Okay, well, fine. Muhammad has a lot of dollars, so what is he going to do with those? Well, the people would argue, well, he's going to dump those dollars just like a hot potato. Okay, fine. Let's say that Muhammad does that. But you got to remember that Muhammad, and he just represents the aggregate balance sheet, the aggregate global balance sheet here. He's got a lot of dollar-denominated debt. In fact, he's got $100 trillion worth of dollar-denominated debt. So if he doesn't want those dollars anymore, he's going to take them out of his bank account with Bank A, but that's going to go to pay the debt that he owes Bank B. Because remember, the banks created these dollars to begin with by lending them into existence. So let's just say that he takes $50 trillion of his dollars that he doesn't want anymore, but he still has that debt, so he needs to take those dollars to pay off his existing debt. So the amount of debt goes down to $50 trillion, but what happens to the amount of dollars that are circulating chasing goods and services in the global economy? It goes down to $50 trillion as well, because dollars are created when they're lent into existence, but dollars are destroyed when you pay off that debt. So the balance, the equilibrium of dollars relative to the amount of dollar-denominated debt doesn't change, whether the number is 100 trillion or 50 trillion. And this is why, just like we pointed out in step number 2, that the United States government can run a budget surplus or a massive budget deficit, and the dollar on the DXY, in other words, relative to a basket of other currencies, pretty much stays at the exact same level. What I'm trying to say here is if you look at history, if you understand the global monetary system, you realize that the domestic policy for the United States, especially the United States government, really doesn't impact the value of the dollar outside of the United States relative to other fiat currencies. Although it definitely impacts the value of the dollar inside of the United States relative to goods and services. So could the dollar go down on the DXY in the future? Absolutely, absolutely, especially if the Fed starts dropping interest rates as other central banks are increasing interest rates or keeping them at the same level. We've got to recognize the impact of interest rate differentials on the value of currencies relative to one another. But will the dollar go down below 70, 50, 30? Will it hyperinflate? Will it turn into toilet paper? Is the dollar doomed? Is it going to crash? In my opinion, that's a very, very low probability. But unfortunately, for the average American, it's going to feel like the dollar is crashing for the rest of the 2020s. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.